You walk into a fancy office building, see people in expensive suits staring at computer screens, and hear them talking about calls and puts like they're speaking in secret code. They're making money appear and disappear faster than a magician at a birthday party. But what exactly are they doing? Today, I'll explain options trading to you like you're 5 years old, and by the end of this, you'll understand why grown-ups get so excited about something that looks suspiciously like gambling but with way more math and fewer slot machines. Now, options trading isn't actually magic, even though it might look like it. It's not a crystal ball that tells you which stocks will go up or down, and it's definitely not a secret handshake that only rich people know. What it is actually is like making a special kind of promise about toys in a toy store. Except, instead of toys, we're talking about pieces of companies called stocks. Imagine you're at the world's biggest toy store, and you see the most amazing toy robot. It costs $100 today, but you only have $50 in your piggy bank. You really want that robot, but you need more time to save up more money. So, you go to the store manager and you make a deal. You give the manager $5, and in return, the manager gives you a special piece of paper. This paper says that any time in the next month, you can come back and buy that robot for $100, even if the price goes up. That special piece of paper is like what grown-ups call an option. You've paid $5 for the right to buy something at a specific price for a certain amount of time. If the robot's price goes up to $150 next week, well, you can still buy it for $100 because you have that special paper. You would save $50. But if the robot goes on sale for $75, then you probably wouldn't use your special piece of paper because, you could just buy it cheaper without the paper. But in that case, you would then lose the $5 that you paid for the paper. But that's okay, because that's all you risked. Now, this is exactly how options work in the stock market. Except, instead of buying toy robots, people are making these deals about shares of companies. A share is like owning a tiny piece of a company. If you own a share of the company that makes your favorite video game, you own a teeny tiny piece of that company. When the company does well and makes lots of money, your tiny piece becomes worth more money. And when the company doesn't do so well, your tiny piece becomes worth less money. Now, there are two main types of these special papers, or options. The first type is called a call option. Remember our toy robot example? That was a call option. A call option gives you the right to buy something at a specific price for a certain amount of time. It's like having a coupon that never expires until a certain date, and it guarantees that you can buy something at today's price even if the price goes way up tomorrow. The second type is called a put option. A put option is like the opposite of a call option. Instead of giving you the right to buy something, it gives you the right to sell something at a specific price. Imagine you own that toy robot and you're worried its price might go down because a newer, cooler robot is coming out next month. You could buy a put option that gives you the right to sell your robot for $100 anytime in the next month, even if the price drops down to $50. If the price does drop, you can then use your put option to sell it for $100 instead of $50. But if the price goes up, you just don't use the put option and sell your robot for the higher price instead. Here's where it gets interesting though, and why some people think that options trading feels like gambling. When you buy an option, you're basically making a bet about what you think will happen to the price of a stock. If you buy a call option, you're betting the price is going to go up. If you buy a put option, you're betting the price will go down. And just like in gambling, you can lose all of the money that you put in, or you can win way more than what you started with. Let's say that you think a company that makes electric cars is going to announce something really exciting next week. You believe that their stock price, which is $100 today, will jump up to $150 tomorrow. Instead of buying the actual stock for $100, you could buy a call option for maybe $5 that gives you the right to buy the stock at $100 anytime in the next month. If you're right and the stock does go up to $150, your option becomes super valuable. You could use your option to buy the stock for $100 and then immediately sell it for $150, making $50 profit. Since you only paid $5 for the option, you've now turned $5 into $50. That's like turning your lunch money into enough money to buy 10 lunches. But here's the risky part. If you're wrong and the stock price stays at $100 or goes down, your option then becomes worthless. You lose the entire $5 that you paid for it. It's like buying a lottery ticket that just didn't win. The money is simply gone. And this is why options can feel like gambling. You can make a lot of money very quickly if you're right about which direction a stock will move, but you can also lose your money very quickly if you're wrong. The difference between options trading and regular gambling is that with options, you're making educated guesses based on research about companies, not just random luck. Professional traders spend lots and lots of time studying companies, reading news, and looking at charts to try to predict which way stock prices will move. They're not just throwing darts at a board and hoping for the best. Well, at least most of them aren't. They're analyzing things like how much money a company is making, whether people want to buy their products, and what's happening in the world that might affect the company's business. But even with all that research, predicting stock prices is really hard. I mean, sometimes companies announce great news and then their stock price goes down anyways. Sometimes companies have problems and then their stock prices go up. The stock market can be as unpredictable as the weather, which is why trading options always involves risks. There's also another important thing to understand about options. They have expiration dates, just like the milk in your refrigerator. When you're buying an option, it's only good for a certain amount of time. It might be good for a week, maybe a month, or even a year, but eventually it expires and becomes worthless if you don't use it. This time limit adds in extra pressure and excitement to options trading. Not only do you now have to be right about which direction a stock price will move, you also have to be right about when it will move. If you think a stock will go up, but it takes 2 months to happen, and your option expires in 1 month, you'll lose the money even though you were eventually right about the prediction. Options also come in different flavors based on how much the stock price needs to move for your option to make money. Some options are like betting that a stock will go up by at least $10. Others are like betting it'll go up by at least $50. The bigger the move you're betting on, the cheaper the option costs to buy, but the less likely you are to win. Think of it like this. If you bet your friend that it's going to rain sometime this month, that's a pretty safe bet, and your friend probably won't give you very good odds. But if you bet that it will rain exactly 3 inches on next Tuesday at 2 o'clock in the afternoon, that is a much more specific bet, an unlikely bet, so your friend might give you much better odds if you're right. Wall Street professionals use options for lots of different reasons. Some use them to make big bets on which way they think stocks will move, hoping to make lots of money quickly. Others use them like insurance policies to protect stocks that they already own. If you own shares of a company and you're worried the price might go down, you could buy a put option as protection. If the stock price does fall, the put option becomes more valuable and helps offset some of your losses. Some traders even use complex combinations of different options to create strategies with fancy names like iron condors and butterfly spreads. Now, these aren't actual birds or insects, they're just complicated ways of using multiple options together to try to make money in different market conditions. It's like playing chess instead of checkers. More moves and strategies, but also more ways to mess up. The reason options exist in the first place is because they serve a useful purpose in the financial system. They help people manage risk and allow for more efficient pricing of stocks. If lots of people are buying call options on a stock, it suggests many people think the price will go up. If lots of people are buying put options, it suggests people think the price will go down. This information helps everyone in the market understand what other investors are thinking. Options also provide what's called leverage. This means you can control a large amount of stock with a relatively small amount of money. Remember our toy robot example? Instead of spending $100 to buy the robot, you only spent $5 to control the right to buy it. If the robot's price went up by 50%, your $5 investment would have made you $50, which is a 1,000% return. That is the power of leverage, but it works both ways. Small moves in your favor can make you lots of money, but small moves against you can wipe out your entire investment. For most regular people, options trading is probably not a good idea. It requires a lot of knowledge, experience, and most importantly, money you can afford to lose completely. It's not like putting money in a savings account where you know it will be safe there. It's more like going to a casino where you might double your money or lose it all. Except the casino is the stock market, and instead of playing blackjack, you're making complicated bets about what companies will do in the future. Many financial experts recommend that regular people stick to buying and holding stocks of good companies for long periods of time, rather than trying to make quick money with options. It's like the difference between planting a tree and waiting for it to grow versus trying to find buried treasure with a metal detector. One approach is slow and steady and usually works over time. The other approach is exciting and might make you rich quickly, but you'll probably just end up with a lot of bottle caps and rusty nails. However, understanding how options work is still valuable even if you never plan to trade them. It helps you understand what's happening when you hear financial news about volatility and market sentiment. It also helps you understand why stock prices sometimes move in ways that seem to make no sense. Sometimes the movement isn't about the company itself, but about all the option bets that people have made on that company's stock. So to recap this whole adventure in finance, options are like special pieces of paper that give you the right to buy or sell stocks at specific prices for limited amounts of time. Call options let you buy, put options let you sell. And people use them to bet on which way stock prices will move, to protect investments that they already have, or to create complex trading strategies. They can make you lots of money really quickly if you're right, but they can also make you lose all your money quickly if you're wrong. That's why they feel like gambling, even though they're based on research and analysis rather than pure luck. Now go forth and impress people at dinner parties with your newfound knowledge of Wall Street's favorite grown-up gambling game. Just don't bet the farm on it.